In this video, traders, we're going to look at how can I ensure I don't lose more than my initial investment when trading. Stay tuned. Hey guys, warm welcome to you. Okay, so great question here from a subscriber. How can I ensure I don't lose more than my initial investment? Really superb question, because people get concerned by this. They see the risk warnings, they think, oh, I'm going to open an account with 1,000, 10,000, whatever. I don't want to lose more than that. They see the horror stories about people who have had a £10,000 account, lost 100,000, then had a bill for it. And you think, then that puts people off. So I'm going to run through some ways that you can guarantee that you won't lose more than your initial investment. I'm going to run through ways that are less risky than others and ways that are probably more risky. So you can kind of decide for yourself whether you want to trade or not. So the first thing is to say is this is when you're trading on margin. If we're trading, i.e. we're buying or investing, should I say, we've got say 10 grand in an account, 20 grand in an account, and we buy shares with that, the lowest those shares can go is to zero. If we're just buying, we've got 20,000 in our account, we're buying $20,000 worth of shares, that's it, whether it's in an ISA or tax-free wrapper or whatever, it doesn't matter. The point is we're not trading on margin, we're not going to be on the hook for anything. The shares will not go below zero. We're talking about trading on margin, we're talking about kind of using margin as leverage and as a tool to gain a little bit more exposure. Let's look at some of the different ways that we could trade things. Okay, the first thing is buying options. Now, buying options is a great way of ensuring that you don't lose more than your initial investment. Now, just to very, very quickly, guys, it doesn't mean any of these are less risky. You can still lose all of your money, which still isn't good, right? We don't lose all of our money, but this is just defining this as stuff that you can't lose more than your initial investment. So buying options, yes, you can't have an option that goes below zero. If you're buying an option contract for 50 cents, 60 cents, $10, whatever it may be, that goes to zero. That's the most you can lose. So buying options is a good way of ensuring you don't lose more than the initial investment. However, selling options, on the other hand, is open-ended risk. You can lose a lot more than your initial investment, and this is how people get hammered. So this is one of the very, very risky ways of trading if you are concerned about this. There are skills and strategies involved in that, and that's something that professionals do. But if this is your main concern about losing more than your initial investment, do not trade or do not sell options. I mean selling them to open the positions, or are you going short options? You can buy your option then sell it to close the position, but don't have a short option contract open, whether that's a call or a put, because your risk is open-ended, specifically with the call. All right, let's look at spread betting. So if in the UK you can spread bet, and spread bet now with ESMA rules, retail have zero balance or negative balance protection. So check obviously with your individual spread bet to check it's regulated, all that kind of stuff, all the due diligence you should be doing anyway. But for retail, if you're marked as a retail trader, you have negative balance protection on new positions opened after ESMA came in. So if you open a position and something goes wrong and it goes way out and you're on margin, you cannot lose more than you have in your account. You have that negative balance protection. However, if you are spread betting now and you class yourself as a professional, then that does not apply. If you have a position on and it gaps against you severely overnight or whatever it may be, you're going to be on the hook for that balance of the position. Same if you've opened a position before ESMA, you don't have the negative balance protection on any positions opened prior. So if you want that negative balance protection and you are a retail classified trader, then take the position out, open it again now, and you should obviously double check with your own broker to make sure this is right, but you should then have the negative balance protection. Okay. Another thing here is guaranteed stops. Some brokers offer these, some brokers don't, but basically a CFD broker or spread betting broker that says, okay, you can pay a premium and they will guarantee that you'll be stopped out at the price you stayed. Now, the problem is why people lose more than their initial investment is the market may move way more dramatically than they expect. They get slippage on the stops and the stop won't execute, especially if the stop is, let's say 100, the market opens the next morning at 80, you're going to get filled at 80. That's when the damage can be done. If you've got a guaranteed stop and you've paid a premium for that, you'll get filled at 100 regardless of how low that does. Some brokers offer that, some brokers don't. That will guarantee that you don't lose more than your initial investment if you've got a guaranteed stop. So speak to your broker about that if it's something that's important to you. All right, so let's look at some things that might be less risky than others. If you're day trading currencies, like the big currencies, Euro, US dollar, USD, JPY, GBP, USD, all that kind of stuff, you're day trading it, the chances of you losing more than your initial investment are going to be slim. Unless you're leveraged right up, the moves are going to be, even if they're dramatic, if you've got a stop loss in place, you're not trading crazy size and crazy leverage over news announcements, you're going to be more than likely okay. You can't guarantee, you can't ensure that, but because you could still be on the hook if something went wrong, your broker went down, you couldn't get out of position, it gapped massively on news. There are things, you haven't got a stop loss in it, runs on, you can potentially have that, but in reality, most of the time, what's going to happen is if you've got a stop loss in, you'll be triggered, you might get some slippage. If you don't, then the broker, most of the brokers, I say most because not all, will margin call you and they will pull you out of the position as quick as they can. So theoretically, we've got potential to lose more than your initial investment there. If you're trading thick markets intraday, not over news, in relatively small size, you're probably going to get away with it. Like I say, do your own due diligence on that. It's not a recommendation, but this would be the less risky thing to do. We're talking about here it moving, whether or not day trading is less risky, the fact that you could still lose all your money from bad trades, that's one thing, but we're talking about extreme moves. Stock swing trading. I'm not going to tick these or cross these, but you get the point. Stock swing trading, this becomes a little bit more risky, right? Because stocks close at 4:30 UK time, at 9 o'clock UK time if they're in the US and your own time zone accordingly, and they won't open again until the next morning. So if you're in a position, you're margined up in a position, some news comes out on that stock overnight, that stock can gap significantly, 10%, 20% more overnight against you. You are then liable for that difference. That's how people get hurt potentially on these things, as well as selling call options, but that's how you can get hammered, because the risk is basically out of your hands and you can't control the risk. You've got the gap risk and you're on the hook for that. So that's super dangerous if that's what you're concerned about here. And obviously if you're trading smaller stuff that's more liable to news, like biotechs, this kind of small cap stuff that can gap massively, or any stock over earnings, then you're vulnerable. Commodities, again, day trade, same with indices, commodities, FX. If you're day trading the thicker commodities like crude oil, gold, maybe silver, not so much silver, but the thicker ones, and indices as well, like Dow, DAX, S&P 500, FTSE, that kind of stuff, you're day trading this stuff, the chances of it ripping away and not stopping you out, if you're using a stop loss and not going crazy size, again, are very, very slim. Again, forgetting about the dangers of day trading itself, but from a point of view of losing more than initial investment, most of the time your stop loss is going to be executed fine. Most of the time the broker is going to pull you out. There's not inherent gap risk. Yes, there's news risk, but most of the time the market will trade through multiple levels of price, taking you out of your position. You won't just gap massively. It can happen, but it's very, very rare. So these are the kind of ones that are less risky, so to speak, in terms of losing more than initial investment. If you start swing trading stuff, stocks is super dangerous because there is that gap risk. Commodities and indices, depending on what you're trading, most of those trade 24/5, so they'll be trading overnight. So if it does have an extreme move, you're probably going to be stopped out anyway. If you're trading gold, crude oil, you'll probably be pinged out of that. Again, if your size isn't huge and you're trading relatively without massive leverage, you're going to be okay. Most of the time you should be okay. Again, there's no guarantee on these ones. But if you're holding stuff over the weekend when everything is closed, then you do have a potential for a gap move, and the gap moves are when you can lose more than initial investment, especially if you're leveraged up. Same with FX, actually. Over the weekend, it's not open on Saturday until Sunday night. So you could have a big gap move. If there was news come out, catastrophic news to the downside, and you're long, you're going to be liable for that difference between the price it closed out on Friday, and the price it opened again the next opening point, whether that's Monday morning or Sunday night, whatever it is. You're liable for that difference. So that's potentially where you could get in trouble. But if you're trading small size, you're trading the thicker stuff, the gaps aren't likely to be massive. Not always the case. There have been instances where we have had huge gaps, but they're rare. And you can kind of work it out yourself and go, well, do I want that risk? Am I prepared to take that risk? You can limit it with a guaranteed stop. You can spread bet under retail. Again, double checking all these things. So there's ways you can mitigate it. The ways you can guarantee you don't lose more than your initial investment. And if you want to kind of play a little bit riskier, there are ways that you can not guarantee but minimize the chance. And then if you want to go full risk and you take the full responsibility of kind of trading something like, let's say, a biotech share overnight, and that's got some inherent gap risk on news, that would be super risky. But as long as you're aware of the risk, it's up to you. It's a big boys, a big girls game. As long as you're aware of it, I think that's the key. As everyone understands what they're getting into, it's all good. So play at a level that suits you, ensuring you don't lose more than initial investment. Thumbs up if you like this kind of stuff. See you next one, guys. Take care. Bye-bye.